because there's a lot of interest in a desire from the markets to see the Fed lower rates, but is it really necessary is the question I'm asking. And I think when we started the year, there were three big forces that our firm was focused on that were going to drive capital flows and really influence investment decisions. And they were the rising cost of living, which we're seeing playing out in the elections, particularly in Europe and in France. That was one of the big issues. You had the deglobalization process that was continuing and actually picking up steam with the issues in the Middle East and Ukraine and South China Sea. And then you had the reindustrialization of the global economy that was going on. All of those backed by two big changes that we haven't really had in the past to deal with, which was the climate transformation and the introduction of generative AI. So since last December, the market's been really pushing the Fed to lower rates so that they could get the benefits of multiple expansion. And I think they felt that the inflation battle was won and that we needed this to stimulate the economy. But the US economy has actually done quite well. So today I want to just talk about, is it really a good idea to cut rates now or not? And what would be gained by it? So let's start globally. A lot happening around the world. There was a big event today in Spain where Powell and Christine Lagarde and the head of the Central Bank for Brazil were speaking on CNBC this morning. About 23 of the biggest banks are forecast to cut rates this year. Japan's the major one that's not. Brazil is also not in the rate cutting mode right now. They're more in a pause. But the idea is they need to get borrowing costs down in a lot of places is what the concern is. But I'm not sure that they're all going to see that through, because I think a lot of people think the battle against inflation has been won because we had the dramatic drop from 10% plus inflation in the US down to 3%, but getting to the last from 3 to 2 is proving to be more difficult. And what you're seeing now in the forecast for a lot of the central banks is they're looking at end of 25 or 26 before they get to the 2% level. So it's going to take some time. The Bank of International Settlements, which is the central banker's central bank, came out last week with a statement that they think that we're on track for a soft landing, but we have to be cautious about rate cuts. And they cited these three areas as their big concerns: weak public finances, productivity lagging, and inflation in two big areas, goods versus services and wages versus cost of living lagging. And also they highlighted the challenges in the commercial real estate area as things that still play through the system. And they've actually cited in their report that it takes up to 3 years for the financial crises to hit once you go through this tightening cycle. And we're still have a year to go. So they are worried about some missteps coming from there. But the ECB had their announcement. They did cut rates in the last meeting, but the expectations they're going to go again, and they're not likely. It looks like they're going to be on hold. And the reason for that is that services inflation remains high. And as you can see from the chart, the straight line is their target. That's 2%. The light blue line up top is packaged holidays. And you can see that's running at above almost a 7% level. Hotels and restaurants are above 5% inflation levels, and all services are running around 4% or higher. So the services side, while goods have come down, the services side remains a problem. For Europe, it's not dissimilar in the US as well, that services remain high. The other challenge for Europe and I think around the world is that we've had these big wage increases come through, but a lot of them have only hit in the last couple of months through negotiated contracts. And I said at the beginning of the year that one of the issues for the ECB was 41% of their negotiated contracts were either finalized in the fourth quarter of last year or in the first half of this year, meaning the inflationary impact is not going to show up until the second half of this year and beyond. So that you're going to see wage pressures continuing to persist inside the system, even though the wages haven't necessarily all flown through for the increases that were coming. They're just starting to hit now. And that's part of the frustrations I think you're seeing from the populations there. So shifting gears to the US and to the globe in a
Stephen,
minutes.
do we have the slides?
Asking the question, why would you cut rates now?
Yeah, Stephen.
And
Stephen.
should the Fed move now? You typically cut rates to stimulate demand and offset economic weakness. In the US, there are pockets of weakness, but overall, the economy is doing quite well.
Stephen.
So cut rates when you want to stimulate
On call.
Is there a problem, Mark?
Yes.
You're not showing your slides.
All righty. Let me go back for a bit. So the slides you missed are this one on central banks cutting. This is where the services is, wages or service inflation remains high. This is the wage inflation that I was talking about, and you can see that with the negotiated contracts still coming through, that's elevated. And this is where we're shifting gears to the Fed now. And you would typically cut rates to stimulate demand and offset weakness, but in the US, we're still growing at a pretty healthy rate, even though the GDP now just dropped considerably. I think you have to be careful about those numbers. We're running at a 2 or 3% GDP growth rate. Our markets are at record levels, and our interest rates are not historically high. They're just high relative to where we were the last 15 years. And demand seems to be quite strong. So what we really need to do is get increased productivity and lower inflation, not stimulate financial activity or offset economic weakness, because overall the economy is doing quite well. I think what the markets have been focused on is, because they're not seeing the rates come down fast enough, they're not getting multiple expansion, and earnings are not being broadly developed across companies, so that, in the second quarter, 90% of the returns in the S&P came from NVIDIA, Apple, and Microsoft. So the earnings aren't well broadly diversified, and I think that's what the market's focused on. So to get returns out of the market, they need to see multiple expansion, and to do that, they want to see rate cuts. And the market and the Fed's not going to comply. And this just shows the probability of a rate cut for the June meeting, and they're looking at almost 9% on the rate cuts there. If you look at the going into December, they're talking about potentially moving from where we are at the 525 to 550 on the right, where we are today, between 1 and 4 rate cuts, and we just don't see that happening. And we could make the case that you don't get any rate cuts this year, and I'll give you a couple reasons why in a minute. But one of the big issues, and there's a lot of hope that generative AI and other tech advances are going to have this massive productivity improvement. But if you look at productivity in the US going back, and this is non-farm productivity, from 47 to 73, you were running at 2%, 2.7% productivity. From 73 to 80 and through the 90s, you were running under 2%. From 90 to 2000, you were at 2. And up in the after the tech bubble wreck. But once Apple came out with the iPhone, Google really hit their stride. Hadoop came out in 07. All these tech advances have not created this technology productivity improvement that we would have expected to see with the great tech advances. And we're below what the average has been from 47 to 04. And if we get that number up, this is the big issue for the world. Productivity improvements. Productivity is the antidote to inflation, and we got to get that going. And yet we're struggling with that right now around the world. So this is a big issue for offsetting the inflationary pressures. The Fed also has a dual mandate, unlike most of the other central banks. So employment is one of their big issues. And as you can see, we have a full employment right now, even though it's starting to creep up a little bit. But I would suggest that if we start to tighten up on immigration, as is being suggested, you could have labor shortages again, which could put wage pressures up as we move forward. So that's something to keep an eye on as well. And the other issue is, would a Fed rate cut solve the housing crisis that we have now, where you have so many homeowners who have been in their homes not willing to sell to give up a 2% mortgage or 3% mortgage to get a 7%? And if you look at this chart, what you see in the blue line is the 30-year fixed rate mortgage in the US going back to the 70s, and the red line is the Fed funds rate. And I would suggest that the movements in the Fed funds would not be mirrored by the mortgage rate declines. They would be much more muted because mortgage rates tend to be more tied to the long end of the market rather than the short end. And I just don't see that solving that problem. We have had, interestingly, in the US, 5.8 million homes have dropped their low mortgages and sold and been replaced with higher mortgages. So you are starting to see, since 2002, so you are starting to see some turnover in those low mortgage rates coming back. But this would also say that 7% mortgages, this is the historical average here, has been below 7.5%. Only during the period from 2000 forward, really, and a brief period in the 70s. So 7% mortgage rates are really not abnormal, and we should be going through an adjustment process to get used to that. But I don't think a Fed cut would solve this problem at all. So I think that's part of the issue. I think one of the other things that's confounding central bankers, and it's this really interesting shift that's been going on for a while, but has become much more pronounced lately, is this shift from consumers spending on experiences versus goods. And what's interesting is a share of discretionary spend. You can see the different directions they're going. But I would say there's another factor that we're not used to right now, which is the amount of net worth held by people retiring and having more time to spend is much greater, and they're living longer in retirement, greater in experience spending versus those spending on goods. And I think that shift is being pronounced, and we have to adjust our investment thinking to deal with that. But central banks have to adjust their thinking into how we deal with these imbalances when you have these sharp moves like you've seen from 2001 to today in the shift from goods services back to services. So I think those are the changes. I think there are several other issues that central bankers are looking at today that they have to focus on. With the Fed's case, it's also record deficits and the potential roll-off of the sunsetting of the Trump tax cuts, which could increase the deficits by up to $2 trillion. So we could jump from $2 trillion deficits that are being projected today to $4 trillion if those tax cuts don't sunset. We have labor supply and immigration issues, which could change dramatically if we really shut down the border and don't back it up with a better immigration policy. We still have the continued effects from the fiscal stimulus that came in late in an expansion, which is highly inflationary to begin with, but gets even more inflationary when you do it late. And then it's not only being backed by the federal government, but state and local governments are stepping up their fiscal spend to attract business or to offset some of their problems. And then that's even being further backed by increased CapEx, like we're seeing with the Amazon announcing $100 billion spend over the next 5 to 6 years on data centers alone. So corporations are backing up the spend too. Another factor that the central banks have to look at is tariffs and the impact of that on inflation. And does that increase the inflation on imported goods? What is that going to mean? Can we back that up? Does that create more supply and demand imbalances? And it's not just the tariffs, deglobalization and the problems we're having with supply chains and the problems in the Strait of Hormuz and flowing through the Gulf versus sending it around the long way is actually adding to the inflationary pressures as well. You have climate change, and then that's still playing through. And one of the other factors is that I touched on is this shift of goods to services is when you have a record number of people living longer in retirement, retiring with massive sums of money, and it's the consumer net worth right now in the US is about $156 trillion. And I would think about 75 trillion of that is going to be transitioned over the next decade or two. And that's massive spend moving around. And that has to be factored in because what we're seeing is the consumer trends are not the trends of the past. So these are all forces that I think are going to keep pressure on the central banks to be more cautious about how they manage rates. And that's not what the narrative is that you're hearing. Quite common. So Mark, I'm going to just stop there and just leave you with these last couple of thoughts. The U.S. remains a very strong economy, but quite frankly, the central banks are struggling with where the neutral rate it should be. The other issue is the central banks are tightening, but fiscal policy is accelerating, particularly in an election year, was the incumbents are trying to preserve getting reelected or not. And I think so we have this kind of break and accelerator economy, which gives you these fits and starts and makes it difficult for investing. Also in the US, you have two very divergent policies potentially coming out of the election. And we got this far without really getting into elections, so we can avoid that till Q&A. But I do think that has an impact on where you're going to be placing your money. And there was an interesting quote from Christine Lagarde last night on the challenge that central banks are facing as they're worried about undoing the progress that they've made since the great financial crisis. And the quote reads as follows: "We're still facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages, and productivity will evolve, and whether the economy will be hit with new supply shocks. And one of the things that the central bankers and the Bank of International Settlements have highlighted is the need to have enough room to lower rates if we have a financial crisis and a big one coming. And that is a concern that they have in the back of their mind, that they won't have enough to support the system if we run into that. We do have some offsets to the inflationary pressures because generative AI, GLP, and the advances in healthcare and climate can all be deflationary after you get through the early stages of the initial spend. But then you have the debt servicing and tariffs covering some of that. So to us, this goes back to you really want to focus on individual companies with strong balance sheets, with strong cash flows that can meet the fund the investments required for growth to move forward in this environment. Because I think getting cash is going to be a lot harder, and getting funding is going to be a lot harder than people think, because we're still stuck in the mindset that zero rates are going to be coming back. And I think that's the challenge for the markets. So we'll stop there. Open it up for comments and debate.
Great. Thank you, Stephen.
You're welcome. Sorry about the AV problems.
All good. Andy Fish.
Stephen, you made a point of putting your mortgage chart up and that it's sort of normal. The 10-year hovering above 4% right now, and it has been. So that's typically what the mortgage keys off of, but you also have the prime rate, high yield. So wouldn't you conclude that normalizing the Fed funds rate is just going to normalize the yield curve and isn't going to have any great stimulative effect?
Yeah, I think you need, when central bank cuts rates to stimulate the economy, it's when the economy needs to be stimulated. And I don't think we're in that mode right now when the US economy is growing the way it's growing. I think if I was in BCP's seat, that's a different problem, because the dispersion between countries inside the ECB is so great. But overall, the US economy is doing quite well, and they have to look at it on an aggregate basis. So I don't see why they would be cutting, and I don't think they would get the benefits of stimulating when we have a fairly stimulated economy overall, in part because of the fiscal stimulus being so massive still coming through the system.
But the question was, if they did cut rates, it wouldn't really do very much, would it?
No.
Okay. That was the question.
It would really, and it would help. It would hurt savers a little bit, and would ease some of the short-term funding needs of the government, because a lot of our debt is funded short, and we need to start moving it out.
Absolutely.
So it would take some pressure off of short-term debt, but it won't help long-term debt needs. And it won't create much stimulus, in my view.
Adam.
Good to see you, Stephen. Thank you for your presentation. We missed you these past 2 weeks, although Sean did a fantastic job. My question is, if they cut, two questions, the new rates or these rates, this is the new normal, or is this the normal? And how long will it last? The second question is, if the Fed does cut rates, how does that affect the global economy, the Europeans and Latin Americans?
Can you give me the first question first again?
I forgot.
It was like, is this the new normal and how long is
Okay.
normal?
Thank you. So
Thank you.
Actually-
Come on.
actually, what we've just experienced is not the normal. And that chart that I showed on rates was actually saying that mortgages and Fed funds were historically out of line. Let me see if I can find this chart again.
And the second part of that question is, how long do you think this is going to last?
I think we're back to
Normal.
I think this is normal. I think we have to adjust our mindset to this being normal. Because if you look, this is the Fed funds, and other than post-World War II and the great financial crisis, you don't see Fed funds anywhere near these levels. And on the mortgage rates, if you look at it just historically, these mortgage rates are in line. The only period that they've been lower than this again was, a financial crisis in the early 70s and the great financial crisis period. So I think the mindset issue, I think this you've cited, Adam, is the market has to get their mindset back to the Fed's not going to carry them, central banks aren't going to carry them, and companies have to stand on their own and economies have to stand on their own.
Great. And the other question is the global impact.
If they cut rates, that'll actually ease some of the dollar pressures. So it'll create less pressure on the rest of the world for the commodities that are traded in dollars. It'll make some of our imports more expensive as well. But that's all things being equal, and they never are.
Thank you, Stephen.
You're welcome. I do think, though, that a lot of the central banks, like ECB, is basically on pause right now for the next cut. So they're not rushing to do another cut because they're not comfortable with the potential that they're seeing. I didn't even touch on energy prices, which have rebounded quite a bit lately, and you're starting to see back over $80 again. And we're moving into a period where you could see even higher energy prices. So those are all the things that are weighing on it. And I only touched briefly on the commercial property market, which still has their issues as well around the world. So I do think, Adam, if they brought it down one cut when they do, which I think will be later this year, I think it'll have a modestly positive impact, but not a materially big one.
Thank you.
Other comments, questions, perspectives? Duncan?
Yeah. What do you think how do you think this impacts the commercial real estate market in the US if there's not a reduction in interest rates?
I think you go through the normal clearing process that'll take a longer period. It'll extend the cycle, but you'll get to a clearing. And I think if they cut rates, they would mask the clearing mechanism. I think that's one of the things that's gone on over the last 10 to 15 years is we've have these zombie businesses that that would have been gone already if they weren't carried by lower interest rates. So I think I think you just get a clearing process that we have to go through in all areas when you have excesses.
Other comments, questions? Is that Ann?
Yeah. Hey, Stephen, I love the slide talking about the experience economy and have been following that pretty closely since 98 when they started talking about it. And I know that from owning a digital agency that's mainly services, that it's harder to scale a services business. Talk to me about your thoughts on all the luxury goods that are out there and if digital communities and unique experiences are the answer to helping with that, or what your thoughts are on how you move from an experience economy to a services economy and how that works.
Well, I think everyone defines experiences differently. So like the young people, I think they're going to be less about mega mansions and more about doing stuff, going on trips, and part of this is the adjustment we're going through of the great change of work when you don't go into an office 5 days a week. It really changes the dynamic of how we live. I think that's all flowing through into this new experiential environment. So we're going to figure it out, Anne, is the real answer, because nobody really knows how we're going to end up. Everyone
So
thought
Stephen-
we'd go through this brief period where you'd be never going back to the office, then you'd be definitely 5 days again in the office. We're keep whipping around until we figure out what the real routine's going to be, and that'll help define that. But I think it's going to be different for everybody, and I think that's going to be what is going to be very hard for marketing and for investing, is to figure out
Experiential.
how to track that experiential difference, because
I picked up.
we've never had this many people entering into retirement with the amount of money they have, and so few people coming into the labor force supporting them. And what are they going to get? And what are the two expenses like just for those two demographics alone?
So Stephen, just because we're going to talk about travel in half an hour, and you're also. Did you mean to talk about travel? Or is that just a?
You're. I don't know if it's me or you.
Anyway, I picked up on the segue to travel, experiential travel, because we're going to talk about that shortly. Rob,
The king of travel.
that's right, with the king of travel, Terry Jones,
There you go.
who's now he took over your position.
Yeah, it took me a while, but I finally got the most competent person to be the chair of the.
Can you hear me okay? Yeah, Steve.
Go ahead, Rob.
Hey, Mark, it's Rob Colorina. Can you hear me?
Yep. Yep.
Okay.
I'm going to
Probably
take you
talked
off video.
Yeah.
Keep
All
going.
right. You
Yep.
probably
Keep going.
talked about this earlier, post the presidential debate. Steve, were you surprised at the European sort of public commentary of them being more concerned, probably even more than the U.S. with respect to? I'm not trying to play politics here, but I was just curious about that sensitivity reaction from Europe to the U.S. side.
Not sure I understood the question, Rob. Sorry.
He doesn't know either.
Easy.
I'll put
I
it.
think-
I'll put it in the chat box. I'll put it in the chat.
I think he was he was playing politics without playing politics. And he was asking about how do the Europeans, were you surprised at the Europeans' comments on the US election, their concern?
I don't have, I'm not even sure if I'm surprised about anything with politics these days, but I don't know why they're focused on our election as much as their own right now, because there's a handful of issues in Europe on their own elections. But I think their concern about the outcome of the election is really what the support of the U.S. will be in Ukraine as much as anything else. And is Trump, and if Trump was to win, how would he react to the rest of the world with tariffs and all that? I think it's too soon to know. I think the whole thing's is still too close to call in the election anyway to have a real view.
Well, but actually, I on the subject of European elections, I did ask our old friend Christophe Charlier, who I noticed in Facebook, Christophe, that you said that you had voted. Maybe you could tell us who you voted for, but just how you see the panorama in France and Europe, and what we should be thinking about as you enter into this final round.
Yes, thanks, Mark. Hi, everyone. Very happy to be part of this call, and unfortunately, I wish it had been a bit of a rosier discussion. I'd be much happier to talk about French football than about French politics, but it is what it is. So just to give everyone a 2-second update on how French politics works. So the president is elected every 5 years. The prime minister is selected by the president based on which party has the highest representation in the parliament, which is also elected in 5-year periods. there are 577 deputies elected throughout France on 5-year terms. So the outgoing parliament had about 250 that represented the government's, the president's majority, the president's party, and with a few of the center right and center left party that kind of gave President Macron over the last few years the ability to govern France, although the extreme right and the extreme left were making it more and more difficult. Following the European Parliament elections on June 9th, Macron made what I believe to be an absolutely ridiculous and foolish mistake. He thought that by dissolving the parliament at that point, he could assuage the frustrations that the French expressed at politics. And he thought, and I don't understand how, that this would allow him to actually go from the 250 to a majority of the parliament. That, to me and to most political observers, was very, very, very unlikely. Of all the scenarios that could happen, that was the least likely one. So it seems very strange that someone who's been president for 7 years would make that kind of mistake. Now, for the results of the first round, we had 66.7% participation, which is very high in France. 33% of the votes went to the far right. 28% went to the far left. 21 went to the presidential majority, and only 6.6 went for the Républicains. So this is Chirac and Sarkozy's old party. In number of seats, that represents about 297 wins for the far right, 191 for the far left, and 65 for the presidential majority. But in France, we have 2 rounds of voting, so those wins don't necessarily convert to deputies. We'll have a second round of voting on Sunday. The first 2 candidates in each circonscription will participate in the second round, and any other candidate that has more than 12.5% of the votes of registered voters, so not participate in the second round. So we have a total of 310 out of 577 circonscriptions or districts that will have what we call in French a triangular, which means that there will be 3 candidates. Obviously, some of those candidates that have very little chance of winning are dropping out in order to open the way, either if they prefer an extreme right or an extreme left candidate. So far, the last call on that will be in about 24 minutes at 6 o'clock Paris time. So far, 200 candidates have announced that they will drop out. 118 of those are from the far left, and 78 of them are on the Macron side. So that means that of the 300 triangular votes, you can expect that close to 200 will go to the far left. So if you up to 400. If you look at the latest estimates, the far right will not have a majority. To remind you, it's 289 is the absolute majority. The latest estimates are around 255 for the far right, 145 for the far left, 85 for Macron's party, and about 51 for Republicans. So the most likely scenario is that we will not have anyone have absolute majority in the parliament, which frankly, given the 2 alternatives, which either the far right or the far left get power, is probably the least, let's say, disastrous situation that can come in. And actually, if you look at the market's reaction and what investors are hoping for, that's pretty much what people are hoping, right? If the far left wins, we'll go back to extreme socialist measures of the beginning of the Mitterrand presidency in the early 80s. So, higher tax rate, wealth tax coming back, lowering of retirement, and increase of tariffs and all of that. The far right, it's a very populist party, so they've announced that they would reduce the retirement age, they would reduce VAT on what they call essential goods. They haven't announced how they will finance all of this, other than to say that they would remove all incentives for immigration. So, not very helpful of a policy. Whereas, if the government, if the assembly is split between the 3 parties and no one has the absolute majority, we'll have basically a logjam for a year. The president can dissolve only once every 12 months. So, we would be stuck in limbo for about a year. Macron would dissolve the government in a year, and we would do another election. And at that point, hopefully, the center or the center right would regain power. I don't know if
What do you think the effect is on the German political scene from what you just saw in France? Christoph?
Did you hear that, Christoph?
I think that the Germans are kind of seeing the same kind of tendencies as in. Yeah, can you hear me?
Yes.
Yep.
Historically, the French-German relationship, is what has driven Europe. If we get a far-right party in power, which is very nationalist and is flirting with Frexit for the last several years, that creates a lot of issues, obviously, for European Union integrity and unity. What's different in France relative to many other countries, actually. Yeah, can you still hear me?
Yes.
Yeah. I just turned your video off, so just to make sure. But go ahead.
Okay. Yeah. What's very different between France and some of the other countries is that the Macron has been running a very centrist way at the socialist and the Républicains, so the center right and center left parties, and that's what's led to extreme parties on the left and on the right being so powerful. You're seeing a resurgence of the extreme right in many countries, obviously in Italy in the recent elections, and in Germany in the parliamentary elections, European Parliament elections recently, but there hasn't been the eating away at the centrist parties as we've seen in the past in France.
Thank you.
Anyone, any questions to Christoph or other comments on European politics, French elections?
Christoph,
Mark, if I can address a question that was asked earlier about why the Europeans are looking at American elections. Obviously, the two parts. One of them was mentioned Ukraine, but I would say more broadly, it's the whole American engagement with Europe. With NATO and also in economic integration. So there's a real worry of American growing disinterest with a partnership with Europe, with all of the negative consequences that would have for European security and economics.
Do you remember the expression that you coined at our 2018 conference about basically Trump's foreign policy towards, I think it was Africa, in the absence, basically we had there was an American vacuum around the world at that time. You called it irrational something, or I thought it.
Yes, I can't remember what the irrational was the adjective. I don't remember what the noun was though.
But I do remember what you did, and it's too bad you're not the chairman of the Brooklyn Nets anymore, but you gave us a box for both the game and the hockey game the next day. So I thank you again for that.
Of course. I look forward to doing that again once the Brooklyn Nets get a little bit better. I'm afraid we wouldn't have a great turnout next season if we were to do that again.
Yes. Well, hope dies last, so we'll figure it out.
Yes.
Any other comments, questions on European politics? Or I think, Joel, you were going to talk about China again. I'm curious how does Europe view China today, Christoph, in view of this geopolitical dynamic?
Europe is very worried about China. Obviously the Chinese infiltration into economics and politics of European countries and throughout the world is something that we're very worried about, and at the same time realize that Europe is not powerful enough to be able to confront that without Americans' support and leadership.
Actually, Mark, I wasn't going to ask about China. but
Okay.
I'm informed by it. I just wanted to go back and talk about this experience economy. And just,
Okay.
I just personally noticed how many brands are leaning into that. I mean, in China and other places in the world, everywhere I go, seems like savvy brands are developing certain kind of brand experience centers that are front and center everywhere. And it just seems that, I don't know, just an observation. And I'm intrigued by this. And I do agree that post-COVID and kind of the mindset of Gen Z is such that, yeah, I mean, I think we need to lean into this idea that people are not going to want to buy and hoard and define themselves by what they own as much. And I think maybe that is really important to pay attention to.
Fair enough.
I think a really obvious example of that is American Express opening these airline lounges, which is absolutely booming for Amex against MasterCard and Visa. It's been one of the best programs they've ever come out with. The other thing I'd mention on European politics is the UK general election, which looks like it will move from Conservative to Labour on Thursday this week.
And what do you think? Hey, Mark, it's Rob. I have a question, but I think Andy's got his hands up. I could wait for him. Andy Fish.
Yeah,
Go ahead, Andy.
I was just going to point out that the Italian government shifted right quite a few years ago for the first time in a long time. And the net result has been, well, whether it's coincidental or not, you can debate, but the Italian economy is doing better than it's done in a hell of a long time. Their policy towards Ukraine has been stable, if not supportive. And I think, generally speaking, the waning attitude towards maybe the European Green Movement has been going on for years anyway. So I don't disagree with anything said, but I'm not sure it's a reason to panic.
I noticed we're all.
I would confirm that the Maloney experience in Italy has clearly been less troublesome than all of us were worried about, when she was first elected. I'm afraid that, the extreme right experience in France minister, who will most likely be named if the far right wins, is a 28-year-old college dropout who's never done anything other than politics. And his only claim to fame is to be dating the niece of Marine Le Pen.
I wasn't giving guarantees, just making a point.
Yes, no, but I do agree with your point.
Christoph, it's Rob. Just a quick thought from the Brooklyn Nets side. And speaking of Asia, I guess the control buyer of that, came from the Alibaba, wealth with the Tsai family. I was just with them a week and a half ago. So I guess is that sort of once removed, once you're sort of in the States and you were able to sort of do capital here, or I'm just sort of resonating on the European wariness of China capital.
Yeah, I mean, Joe is Taiwanese Canadian / American, right? So he's not a very we weren't, at the time, I don't think it was a consideration when Michael decided to sell to Joe. But I don't put him necessarily in the bucket of Chinese soft power that Europe needs to be worried about. I say that differently. I separate Joe from from his business necessarily.
Fair. Okay.
Christoph, since it's been a long time, our classic 361 question is what scares and excites you. So what, apart from politics, in the business world and in light of the war, what scares and excites you about Europe today? You caught that. Your face is frozen with your eyes closed in front of me. Maybe you don't like the question.
What really scares me about Europe at the moment, can you hear me?
Yes.
Yeah.
Let me stop. Did I turn off the video?
Yep.
Yeah. So what really scares me is a shift in political supports for continuing, standing up to Russia and its aggressive position, not only in Ukraine but around the world. I think that if Europe loses patience and kind of gives up on Ukraine, I think that makes the situation significantly more dangerous than it is at the moment. And so, I'm very concerned about the shift in policy against Russia. What excites me is that I think Europe has, understood the importance for increasing its economic and technological independence. And so what I've seen in the last few years, having moved back to France, is quite a bit of investment going into technology and AI, and making sure that France at least has much more independence in some of these new technologies than what we gave up in the early stages of internet and related technologies.
Well, that's fair. And the price of energy, cost of energy is a factor. It's weighing down on Germany. France has put its weight behind nuclear and a few other things. How do you look at energy in this dynamic?
Look, I think there's, I'm a board member of a company called La Française de l'Énergie, which is developing coal bed and coal mine methane solutions, and also hydrogen, both in France and in Norway. So I think, there are opportunities for France and some of the other European countries to balance out their energy needs. The problem is politics gets in the way, regulatory policies get in the way, and sometimes, the thinking of we want to be carbon neutral quickly is not necessarily the right solution as we move forward. So, we're confronting administrative issues and developing our coal mine and coal bed methane opportunities in France, whereas France continues to import Russian gas and American shale gas. So I'm afraid the administrative and regulatory systems are getting in the place of solutions being put in place meaningfully and long term.
Christoph, do you worry about businesses up and moving to the US like we've seen over the last couple of years, where they get more dependable energy and they can also participate in the benefits of the Inflation Reduction Act and other stimulus programs that the US is putting out?
Look, I'll give you a very concrete answer to that question. The company I was just telling you about, La Française de l'Énergie, we're seeing so many administrative hurdles to develop our hydrogen projects in Eastern France that we're actually looking at opportunities to invest in the US to develop hydrogen there, so that we can get up the learning curve where regulatory hurdles are much lower, so that if and when we ever do get the permits in France, we'll already be able to hit the ground running. So yeah, there are massive advantages in these industries to operating in the US, because regulatory hurdles and administrative hurdles are much lower.
The implication of that is really bad for Europe going forward. If you keep sending stuff out at a time you need to turn around your growth and get back on a more sustainable growth trajectory to offset the debt problems that so many of the nations have there.
Yeah, I read an article last week that says that French nationals have created more tech unicorns in the US than they have in France. And that's a clear example of that.